to today's Customs Bond Roundtable, 5 tips to help improve the outcome of a risk assessment. My name is Jennifer Rome, and I'll be your moderator for today's event. Our roundtable is scheduled to run for about 50 minutes, although we've got a lot of information to pack into this session. So we're going to do our best to keep to 50 minutes to allow for about a 10-minute time period for Q&A at the end. All attendees will receive a link to a recording and the slides within a couple of days. Throughout the discussion, we encourage you to type your questions into the Q&A panel that's part of your WebEx panel. We will be answering all the questions at the end of the session today, but please don't hesitate. Submit your questions throughout, and we'll address as many of them as we can at the end. I'd also like to take this opportunity to let you know that all of you are going to be entered into a drawing just for attending today's session. We will draw 4 names to each win a $50 Visa gift card. So stay tuned for that within the next couple of days as well for the results. So let's go into today's panelists or presenters. All of us who are speaking today have been with Roanoke 15 years or more. You can find all of our bios on our website at roanoketrade.com. But I thought I would just give you a small little tidbit about everybody. For example, Colleen has been in the industry since 1988. Patrice Lafayette has been in the industry since 2003. Also, Maya Mackey has been in the industry since 1996. And myself, Jennifer Rome, has been in the industry since 1995. So let's begin. Ever wonder what's involved in an underwriting review, or another term, a risk assessment, as we call it in the 5 tips, and how you can help? So we've got the 5 tips for you today, and we're going to go ahead and we'll start with the tip number 1, which is be aware of current conditions influencing underwriters, such as the economics, the pandemic, and the market capacity changes. Maya has some information to share with you about that.
Thank you, Jennifer. So not much has really gone on this year, right? We had COVID and the businesses that have been forced to close or change their business model. People are losing their jobs. There's an economic downturn and some uncertainty on what's going to happen going forward. There's more bankruptcies this year than there has been in a long time. And then we had the riots and the civil unrest that it caused businesses a lot of problems, and some are still struggling to come back from that. And of course, the trade wars are continuing. So all of that was happening this year, and then what happened?
Who's our next speaker? You might be muted.
Sorry, I was muted. It's me. So how did the sureties respond to this? Well, the sureties have become more conservative. With the economic impact of COVID-19, surety bond providers and really general insurers are taking a very conservative approach. Early in the spring, there was widespread fear within our industry of incurring losses. We'll provide those loss details in a few slides, but I can tell you the fear was real and is real. Debit vouchers and non-payment of estimated duty is higher than in years past. We're also seeing an uptick in supplemental duty bills for classification change. The executive order where the president signed allowing for importers to defer duty payment 90 days was a very big concern of ours because there's no visibility as to which importers chose to delay that payment. So we had all these bonds out there and we had no idea which ones chose to defer, and would they be in business after 90 days to pay all of those duties that were previously owed. We're seeing more claims on bonds issued. We never really underwrite the $50,000 minimum bonds. We're seeing more claims on those bonds, which are all within our clients' issuing authority limits. There's always a stacking liability concern for sureties. And aside from anti-dumping, we're seeing more entries being extended when importers are requesting exclusions for entries where 301 tariffs were applicable. In the early part of the pandemic, these were extensively reviewing and really reassessing and looking at their existing portfolios to see, in areas where there were inherent risks due to the economic issues at the time. Reinsurers are requiring analysis of all of the liability they have outstanding to ensure that their loss reserves are sufficient. And insurance companies have loss reserves. They put so much money aside every year to cover losses. So that was reevaluated earlier this year. And I'll tell you, our underwriting department was going crazy with trying to gather all this information to report to our reinsurers. They're requesting it actually every quarter and more often on the risks associated with COVID, in particular with duty payments. Excuse me. Adding to that, you have the different enforcement actions that we've already been dealing with. You have the tariffs. There's higher scrutiny by import specialists related to classification and country of origin. So in the end, sureties have really dulled their appetite for high-risk business. The current environment, sureties are being more selective, and they can be. They're looking at reducing bond capacity, increasing indemnity requirements, greater financial scrutiny, and elevating their financial benchmark requirements. So in the last 10 years since the Great Recession, the surety market has been a bit soft and underwriting has been a bit lax, right? So keep in mind that you'll likely see a more disciplined approach as in the future of underwriting any bond. I've often said that cash is king, right? Isn't it? We all like cash, but right now there's nothing more important in the surety world.
So that's how sureties responded. Let's talk about the importers then. Whoops, pardon me. There we go. Patrice?
Yeah, so we're going to talk a little bit about how the importers were impacted and are still continuing to be impacted. So unfortunately, during any type of economic downturn, the sureties tend to tighten their underwriting, and things in the past that may have been able to just slide by are looked at with much more scrutiny. Many importers who obtained their bond very easily before are now experiencing a lot of underwriting requests. These may include questions about entry liquidation or extensions, might have aggregate increases, financial statement requests, or even collateral at times. Because of this, importers are now shopping around more with multiple sureties than ever before. One surety might have a large aggregate, but another surety might see the bond as only one risk, and so they might be willing to write that one bond versus multiple bonds. There are several sureties also who don't specialize in customs bonds like we do, and so they're still able to write bonds with U.S. Customs. Many importers have a relationship with them by getting their business insurance from them or even their banking, and so they're able to help them write that one bond specifically. We've also seen a lot of risk-based premium analysis. While all premium that any insurance company can charge or a surety company can charge is based on a risk assessment overall, they're now looking more directly on that risk of the importer as a company. This is really based on a credit review of either their DNB rating, S&P rating, or their Moody's rating, or as well as a financial review, including at times the rates that the importers have received on their bank loans that they have. Depending on the review, there may also be an increase in premium.
So Patrice, on that first bullet point there, something that we've seen in the past is a lot of these importers who have had a bond that just automatically renews every year without any underwriting scrutiny. We're seeing more situations where the underwriters are saying, whoa, now I need to look at some information. Would you agree?
Yeah, definitely. I think a lot of us are used to seeing underwriting on larger bonds, whether they're six figures or even into the millions. But because of this, we're starting to see underwriting on things even under 100,000.
Okay. So knowing all that information, what can you and your customer do to help with these risk assessments? Here's our tip number 2. Make accurate bond sufficiency projections to avoid unnecessary midterm increase demands. So let's talk about sufficiency for a little bit. Colleen?
Sure, thanks, Jen. So we always like to show these statistics. We thought we would see a decline in the number of bond insufficiencies this year compared to 2019. And as you can see here, we did. But part of that was because Customs did not issue any notices during May, June, and July. They typically review every month at the beginning of the month, every single continuous bond on file to determine in the last 12 months, what are their duties, taxes, and fees, and is their bond sufficient? So they did defer those 3 months. Ironically, at the same time, they were allowing importers to defer duty. So it kind of was strange, but they refrained from issuing those. So we're seeing, a good amount compared to all years previous to 2018 in this year. And we don't foresee that ending, given the fact that the government has assessed billions of dollars in these 301 tariffs. And even with a new administration coming in, we don't believe that will be, and 232s will go away immediately, maybe at some point in the future. But I think we can continue to see these insufficiencies. For this year, 2020, the total amount of increases was over 500 million. It was $529 million that Customs required in increases across all the bonds. As of October 31st, there were just over 233,000 continuous import bonds on file, with a total exposure on all those bonds of $23 billion. So think of that. We always talk about stacking liability. So anytime a bond renews, it doesn't matter if there's dumping or not because of the liquidation cycle. That's $46 billion for just really less than 10 surety companies that write Customs bonds, and really 4 that write a lot of them. So think about the amount of liability these sureties are holding. They're holding the bag, right, for that amount. It's astounding, the amount of liability we have sitting out there. And because of the insufficiencies, the minimum bond amount of 50,000, it used to be around 95 to 96% of all bonds were at the minimum of 50,000. That's now 90%. So the trend is higher bond amounts, which is, the proof is there in the statistics, right?
Hey, Colleen, just to clarify, the numbers here, this is not just Roanoke's counts, right? This is all industry?
Correct. It's all sureties that file bonds with Customs, any bond that's on file. And this is just import bonds. I think we're moving on. Okay. So we talked about projecting your bond amount, right? So it's very important, even if an importer receives an insufficient, 100,000 to 200,000, you should always be working with your importer clients to make sure that that 200,000 really shouldn't be higher. So you should help them forecast what they may be paying in the future. You don't have a crystal ball, but you can work with your importers to find out, okay, are you going to have the same amount of entries next year? Are you going to increase your import activity, decrease it, whatever? But you're always going to have to make sure that it's sufficient at the time it's in, that every bond should be sufficient that's on file, because it's an informed compliance requirement. So how can you help? You have that data yourself in your ABI data, right? The problem with that is if there's a continuous bond and you're not the only filer, if your importer client uses other brokers, well, you don't have all of that data. You only have the data that's yours for your filer code. So another option is the ACE portal account, but the problem there is not all importers have a portal account. I think that trend is moving a little bit because they need a portal account to be able to pay ACH for statement. And I know a lot of brokers are moving a lot of their importer clients over to their own statements rather than advancing those duties anymore. So that's another option. And then you have us as the surety. We do receive this data also, but there's a problem with our data too. We don't get line level information. We only get the header information, so that just the totals of total value, duties, taxes, and fees. So your best bet really is to use all of these sources to really assist your client.
Yeah, and just to point out, so we do have ABI data here. For those who don't know, that ABI represents Automated Broker Interface, and us on the surety side have the ASI data, the Automated Surety Interface. And we will be talking at the end of the session about some of the tools we can provide with the data that we get.
So what happens if the importer inaccurately projects their bond? No biggie, right? Well, if it's insufficient and customs shuts them off, there's no entries allowed. If it's grossly insufficient, which, for example, maybe you filed a $50,000 bond for them and 3 months later, customs comes back and says, hey, no way, they need a $5 million bond, we're shutting them off. They shut them off right then. They don't give the few days notice for it to get done. They're just shut off. So then you could have demurrage and storage charges. Single entry bonds could be required, which could get expensive. You might run into underwriting issues because then you have stacking liability aggregate problems, and the surety probably wants to look at a financial. So there's the underwriting scrutiny. And then on the rare occasion, you could run into a surety capacity issue. What if they're tired of writing candy cane importers and they say, these aren't good for us, we don't want any more liability for the candy cane importer? It's going to be a problem. So you want to make sure that the importer has an accurately projected bond on file and they're not going to run into any of these problems.
Yeah, and just to point out, I mean, all of us on this call have seen all of these situations happen when somebody has not accurately projected their bond amount. They do happen.
So I know you all have probably heard us talk about this multiple times over the last few years, whether at a conference or another one of our webinars, but I'm just going to give you a quick little example of a stacking liability. And so, a bond was filed for $400,000. A couple of months later, because they didn't project the bond amount properly, Customs required a $500,000 bond. A few months after that, Customs said that wasn't enough. Now it's $800,000. A few months after that, Customs said not enough again, and now it's 1.8. So 1.8 million. So while it might seem just like a $1.8 million bond, because there are entries filed against each of those bonds, we actually have exposure of 3.5 million, which is what the surety companies are looking at.
Yeah, and Patrice, also just to point out for everybody, this is an actual situation that occurred to one of our importers. So it truly does happen. We're giving you some of our scary stories that could happen. Let's talk about some other scary stories.
Yeah, I mean, so multiple bonds can also equal obviously higher bond amounts. Really, 100% of all bonds are exposed, and that's just because of the liquidation cycle. And many are exposed for actually 2 bonding periods. Since the liquidation cycle is 11 months, all entries can be subject to some type of claim until liquidation. This is also true for drawback bonds and claims, since the claim cannot be closed until the entry has actually liquidated. While the increase in entry extensions, including exclusion order filings, this has caused an even further delay for drawback closures and causing more of that stacking liability now with drawback bonds, not just the import bonds. The risk is with PGA is also higher to anything of an entry that's subject to a PGA. As other government agencies get involved, there's always a higher risk for an issue, a rejection or a claim for more reasons than just customs. So for instance, with FDA, there's a possibility of a redelivery claim in addition to the other customs exposures.
Yeah, and a little bit about the surety and importer exposure, that joint and several liability. Because the bond is a contract, the importer and the surety are both equally responsible for any breach of that contract. So if the importer does not to a claim, the surety is required to settle it and then work with the importer on subrogation. And oftentimes subrogation just is not possible, to get that reimbursement of any losses we pay. For revenue related issues, the importer is always responsible for that full duty payment. Any debt owed to customs, they're fully responsible, whereas the surety is limited to the bond amount. So if you think about it, that bond is fully exposed at all times because it's only 10% of the duty, taxes, and fees. So sureties look at that too, that, what is, the average monthly duty that that importer pays, and is it, close to that bond amount, right? So there's always that full exposure out there. And for liquidated damages, for the importer and the surety, the responsibility is limited to that bond amount. So in that previous slide with that example, the liquidated damage exposure is $3.5 million because every one of those bonds is exposed. Had that importer forecasted what their bonds should have been to begin with, they would have reduced the exposure to both themselves and the surety to 2.2 million, or by 2. It would only be $2.2 million. They need those two bonds in the middle. So by forecasting again, the importer is protecting themselves for this gross exposure on liquidated damages also.
Hey, Colleen, for those who may not know, attending the session today, can you explain what a liquidated damage is and maybe give an example?
Sure. An example would be an FDA redelivery. My mentioned candy canes. We'll talk about fruitcake now. So an entry of fruitcake, multiple fruitcakes, many fruitcakes, they come in and may be inadmissible for entry, but there's a conditional release period. That importer does not hold their fruitcake for 30 days. During that conditional release period, they've distributed it. It's been in the stores. It's on your kitchen table. Who knows? So those fruitcakes cannot be redelivered. Sorry, I'm cracking myself up. Resulting in a claim at 3 times the value. Yet it's limited to the bond amount. So the claim could technically be higher than the bond, but customs cannot issue it for anything higher than that bond amount.
And then you go back. I'm sorry, go ahead.
I'm sorry. If it was a single transaction bond, customs requires FDA restricted merchandise to be at 3 times the value. So in that case, the claim would be the full 3 times the value single transaction bond amount.
Thanks, Colleen. Sorry for interrupting. I wanted to just point out then, so going back to this bullet, importer and surety joint in several liability. So if a liquidated damages is assigned, assessed against an importer's bond, and if the importer can't pay it, the surety has to. That's what the bond is basically saying, that we promise we'll pay if the importer cannot.
Right.
Okay, it's time for a poll. We're going to make it a little interactive for you today. So we've got a question for you. We didn't drill into the details because we've gone over the calculating the bond amount rules in previous webinars. So here's your chance. Why don't you go ahead and submit your answer to how is the standard continuous import bond amount determined? Your choices are A, all bonds are $50,000, B, 10% of the total annual duties, taxes, and fees, C, annual value plus duty, taxes, and fees, or D, average monthly duty, taxes, and fees. So go ahead and, if you haven't already, submit your guess, and we'll just give it another minute or a couple of seconds, and let's go ahead and display the results. That should be enough time. The answer is B. There we go. 10% of the total annual duties, taxes, and fees. We do have a whole section on our website, RoanokeTrade.com, dedicated to bond sufficiency. So we'll talk more about it towards the end of this webinar. But if you need more information about calculating the bond amount, you can find it on our website. So, okay, let's talk about tip number 3. Prepare for the underwriter's review process. Client financial statements are more important than ever. So we've got all sorts of information to talk about what the underwriters review and why, and delve into that information for you.
So why does an underwriter do a review? Well, remember the terms of the bond that we just talked about. It's a three-party contract between the surety company, in this case, Customs, and the importer. And like we said before, if the principal can't or doesn't pay, the surety's going to have to. So they want to make sure as best they can that the importer is going to be able to pay. And they want to try and keep their losses to a minimum. Why is that important? Well, they kind of base their rates on their losses. So if they start having a whole bunch of years of horrible losses, we might see the rates go up, and nobody wants that. I mean, just think about it this way. How many $50,000 bonds at, X amount of premium per bond is the surety company going to have to sell to make up for a $50,000 loss? Or if it's $1 million. So lower losses should equal lower rates. And we want to keep our underwriting authority the same. We don't want to have to scale that back and say, well, now you can't write a $100,000 bond because the surety thinks those are too dangerous. You can only write a $50,000 bond. So we want to try and keep everything the way it is. And the surety does too, because they don't want to start reviewing every $50,000 bond out there. They just can't do that. So that's why the underwriter reviews.
Maya, do you think that's what our underwriters look like, Santa Claus?
Well, I know they have big lists of things to do. They probably have more gray hair, because I know I do. And I've gotten a little chubbier. So yeah, they probably kind of look like that.
Making their list and checking it twice, that's for sure. Okay, so Colleen is going to talk about bond losses, and I just have to say that this is the one slide that we could not make holiday because it's just data. But Colleen's great at sharing really good data that we think you're going to really like this part.
Really good data, and I love statistics. I don't like these loss trends, so I'm kind of more of a Grinch when I go through this. Santa Claus is not in this room today. So I am kind of about statistics. We are seeing high, these loss trends are just, that it tells us of the time that we're in, these economic times. If you look at 2018, 51%, half of the pie, a little over half of the pie, all of our losses, now this is just import bond losses, were concentrated in anti-dumping and countervailing duty. Right? Makes sense. It's very high risk. They pay, some amount today and it liquidates in 3 to 10 years at some higher rate. 10% was estimated duty claims, debit vouchers, which is a bounced ACH payment to customs. Then in 2019, that estimated duty went to 12%. But look at this in 2020 through just 10 months. 30% of the losses we have paid this year are all for non-payment of estimated duty. Obviously, that is indicative of the economy right now and how it's affecting companies and their ability to pay customs. Another fact, yes.
Oh, I'm sorry. I just wanted to ask you, for those who may not know on the call, what is 1592D?
Yeah, it's fraud duties. So, and that can happen after liquidation, even though we always say, our ability is long because of the 11-month liquidation cycle. Customs there is a statute of limitations where customs can go back. And if they find that an importer was somehow committing fraud and there was duties still due because of that fraud, say, transshipment. They're saying, it came from Vietnam and it was really from China. And there was a full audit of this company and customs comes back and finds that, no, it was really China and they owe a higher duty amount. Even though those entries have been liquidated, customs can come back and demand payment because it's revenue. And so to go over the amount of losses that we have paid, estimated duty, through October of 2020, we have paid almost double what we've paid in the entire year of 2019 and more than triple of what we paid in 2018. Again, a sign of the times. estimated duty in 2020 is 400% over 2019 and 1,000% over 2018. Obviously, it goes from 10 to 12 to 30% of our total losses. So in the last 15 years, we went through and looked back at the last 15 years of loss data that we have, and there were only 2 other years where estimated duty losses were higher than anti-dumping. Take a guess. It was during that Great Recession, 2008 and 2009. So we expect this trend to continue into next year, thus the reason for the tightening of underwriting.
Colleen, just to clarify, these figures here on this screen are Roanoke losses only, correct?
That's correct.
All right. So let's talk about when the underwriter reviews.
Yeah, so if you've been lucky enough not to have to go through an underwriter review, then this is kind of gives you some tips, but I'm sure many of you have already been through them before. At the time of a request for a single transaction bond or a continuous bond, an underwriter might review the risk on the bond. At most surety companies, and we do give brokers a standard issuing authority where you can issue a certain bond amount and commodity for a domestic importer or foreign importer up to a certain amount. So if that's outside of those limits, that's when the surety company reviews. Also, if there's a problem with the importer or we have a history with claims with the importer, our system will also stop that so that they will be looking at the request at the time that you put in the request for a single or a continuous bond. With continuous bonds, we also look at renewals. So the underwriters they try to look at about 3 to 4 months prior to the renewal month to start assessing all of the bonds that we write. Their goal is to finalize that risk assessment prior to the bond renewal to give them enough time to terminate a bond if they don't want to be on the risk anymore, with the 15 days to give to customs for that bond termination. There's also a time that throughout the bond period, the underwriters may also review the bonds for irregular activity, such as maybe there's an increase in claims or the importer may have shifted to a different supplier. So anti-dumping is now on the bond, and there may be some midterm reviews on any bond that is written, no matter the size. While it seems sometimes if you get a lot of requests for underwriting that we are looking at every single bond, it's just not possible. With the amount of bonds that we write, it's not possible to look at every. I would say that about 95% or so of our bonds pretty much slide through without looking at underwriting. So it really is a small percentage as a total.
Patrice, that bullet about the renewal 3 to 4 months prior to the renewal month, I just thought I would point out to everybody that we say 3 to 4 months because the underwriters will issue their requests to our regional bond departments, who then disseminate the requests out to our customers. But there could be times when we automatically don't even go to you and go contest the request with the underwriter. So it could take a little time for us to go back with our "oh, come on" to the underwriter, or maybe they missed something, like the customer's financial statements are publicly traded or on their website, to where the underwriter can get the information that they need. So we try and save you whenever we can, because it's less work on us and it's less work on you and your customer if we have to ask for underwriting information. Okay, so what does the underwriter review?
Well, they do a subjective review based on the bond amount, the principal's history with us, aggregate liability that we have for that principal, the commodity, the duty rate. Before they ask for a financial statement, sometimes they'll look for a DNB or some other credit rating. There's not usually a lot on a DNB, but sometimes it'll be helpful and we won't need to ask for a financial. But if we can't get anything else, and the underwriter determines that we need a financial, then we'll ask for the financial statement.
So Maya, early on in this presentation, Colleen mentioned it, but I thought I would just point it out again. Sometimes we'll go to our customers and ask for the commodity information. And just to clarify, The data that we get through the automated surety interface, the ASI, is summary level only. So we don't get the line level detail to know the tariff numbers or the, the commodity information on a continuous bond. So that's why many times you'll get a request from us that just says, what are they bringing in? So we've had that before where customers say, well, don't you know? But no, unless you tell us, we don't know.
Yeah, that's correct.
And I'm sorry, can I interject there too? For duty rate too, just talking to the senior vice president of underwriting recently, I said, okay, so when you say duty rate, what do you think is risky, and or what do you think is safe? And his reply was anything 10% or less. Obviously is lower risk than something higher than 10%. So keep that in mind too. If we're looking at commodities that have very high duty rates, the tariffs, right? I mean, the 301 duties, the 232 duties, as well as just duty rates and many items out of China, in particular, textiles, they have high duty rates. So that's something to keep in mind too. And sorry for interrupting.
No, thanks, Colleen.
So what do they look at in history? Well, they look at the bond amount. Do they just have one $300,000 bond, or do they have a $3 million import bond and $1 million drawback bond and 3 other types of bonds? They look at that in the aggregate. They look at the commodity and the entry types. Is it widgets or is it honey? Is the duty rate 0 because it's a commodity that's always 0% just by the nature of it? Or are they paying 0% anti-dumping duty? Those are 2 really different things. And as Colleen said, they really like to see duty rates of 10% or less, a little bit better about everything. So what are the red flags? Irregular entry activities, such as the anti-dumping countervailing, entries that are extended or suspended, but they're not dumping. So we would probably go to you and say, why is Customs looking at this? What's going on? They look at the liquidation history. Are things just sliding on through in the normal liquidation cycle? Or are they kind of getting hung up a little bit and what's going on there? Are there open claims? And that's not always a red flag. Maybe they've been our customer for 20 years, and over the 20 years, there have been a couple little claims here and there that the importer's taken care of, no problem. Or is it a pattern where they always have a bunch of open claims and maybe that's going to be a problem? Are there paid claims by the surety? That's always going to be a problem because the surety doesn't want to be paying claims. So they're going to be looking at that really close.
Okay, so the financial statements that we request, this is just sort of the format, and then we'll go into a little bit more of what the underwriters are looking for specifically. But we're looking for a complete year-end financial statement that is usually defined as a 12-month CPA prepared financial statement that includes a statement of income, balance sheet, statement of cash flows, and any accompanying notes. And the cash flow is very important because surety companies want to look at cash. And then the accompanying notes is as well, because those types of things can explain why there might be a certain amount of debt or what, kind of bank rate they have, or even, where their cash is going. If there's been a big deposit from an owner because the company may have needed that. So those are things that are really important to look at. If it is not CPA prepared, then we do usually require a company officer to attest to the accuracy, just to say that this is, true and valid and not just printed off the internet.
Yeah, Patrice, so on that second statement there, a lot of our smaller importers don't have a CPA prepared financial statement. So can you give a couple of examples of what we've accepted in the past?
Yeah, it doesn't necessarily have to be CPA prepared. It can be any kind of internal software that you're using, like QuickBooks. You can print an income statement and balance sheet from that. And that's also common because a lot of the times, especially this time of year, maybe someone's year end is 12/31. So there's only 2019 financials, but that sort of leaves us with 11 months of a lot could have happened, as we've been talking about in the last 11 months in particular. So sometimes we also want to look at maybe the last 3/4 of the year of the 2020 year to look at. So that those can also be internal and any kind of software that you currently use. So in the financial statement review, this is a little important just because, if you're looking at a standard of a financial statement or, a CFO is looking at something, the numbers are going to be very different than maybe what the surety company is underwriting. The most important thing is, tangible assets and things that can liquidate within a year. So those things are cash, for sure that you have automatically. Working capital, net worth. These are the types of things on a balance sheet that are really important. Inventory is very big, especially for anybody that has a brick and mortar store. But those types of things, if they're not selling often and it's not turning over 4 times a year, then there is some discounts to those numbers. So while it's important to remember that with an importer because they might think that they have a lot of inventory and that should be considered an asset, but we might discount it just because it's not selling as quickly. And really, when you have the exposure with the bond, and if the surety company has to pay customs, they just want to make sure that that importer can pay up to that bond amount for any entries that are used. Also, in a balance sheet, there's things like intangible assets and goodwill with goodwill or trademarks. So, using kind of our Christmas thing, Santa probably has a trademark on Rudolph being the only red-nosed reindeer out there, but unfortunately, that's not really considered a tangible asset for us to use in our financial review for underwriting. While that can mean money to a company and they might be able to sell that trademark or, that goodwill of their company, like a brand name, you don't know how long that will be to do that, to get that money. And you also don't know what the market value is. That could be today versus in a year from now. So those are some things that we sort of look at in terms of that are a little bit different than a normal CFO would look at in a company's financial review. The other thing on the income statement, we're really just looking for profitability, making sure that the company is profitable, that there is a positive net worth and positive net income. So that is something that, sometimes it's equal to the bond amount, sometimes it's more, but just really making sure that the company is making money. With cash flow, it's really just looking at the cash availability that the company has today. And then the notes, like I mentioned before, those are also really important for bank loans and long-term debt that might be on the balance sheet as well. And lines of credit. So they're looking at interest rates. Interest rates on your bank loan, today interest rates are really low, maybe 3%. But if a company's getting a 10% interest rate on a bank loan, then that means that their bank is maybe not seeing them as a best financial risk either. So it gives the underwriter a little bit more scrutiny with them, because if a bank doesn't have the same amount of trust in them, then it's going to make us kind of feel the same way. Also, sort of how long they have to pay off those bank loans or those lines of credit, if they're going to be paid off soon, or are they going to be paid off in 3 years? And so if their financials are already declining, but they still have to make this big payment in 3 years, that also causes some concern.
Hey, Patrice, let's talk about the touchy subject, because this can be a little touchy with some of our customers where we ask for a financial statement and they go, I'm out. Talk to my importer directly. I don't want to see their financials. How do you respond to that?
Certainly we don't need you to look at financials, although there is some thought to think that you might want to see them sometimes, because you really should be doing some kind of a financial review as well, especially if you're fronting duties on them. But if not, we can sign non-disclosure agreements. We have done that before, so that, an importer feels that, more comfortable with us getting the information. We're not going to release it publicly. They can also send it directly to any of our bond service reps rather than having it go through the broker. And then we will just communicate with them the information. We won't give details to the broker necessarily of the financials, but we would communicate what we would need.
Colleen, you might be muted.
Sorry about that. So what happens if financial statements are not enough, or maybe they don't support the risk, right? So we can look at third-party financials. If your importer client has a parent company or some related company that is in a better financial position and willing to sign an indemnity agreement for that importer to obtain the bond without collateral, we can certainly take a look at those. An indemnity agreement, we were talking about this the other day. It's much like a parent signing as on a loan for co-signing a loan for their kid to get a car, right? So it's the same type of thing where the parents are in a great financial position and the child maybe doesn't, right? So it's the same type of concept where it's like a co-signing or indemnifying for that importer. Collateral, sometimes we just can't avoid it, right? And it's not always a one-time requirement, meaning that if that stacking liability, we have open liability. Once a bond renews, you can write it today, but once it renews next year, there's another term of liability. It's open liability that the surety has on their books. Another option is maybe we could take less collateral, but a higher rate of premium. A lot of sureties do that. We talked about it a little on one of the previous slides, risk-based premium. So you're looking at that, or rating, I should say. So you're looking at the risk and saying, well, wait, pretty high risk compared to, that guy that imports widgets. We'll do this with 50% collateral, but we need to get a little bit more premium on it.
Okay.
And regarding collateral, so the most secure form of collateral is a letter of credit. And that's because with cash, if we take cash, we are bound by that clawback period, which the customs brokers, the NCBFA has been trying to get legislation passed to remove that clawback requirement for both the brokers and us as sureties, because if we take cash collateral today, and that importer were to go bankrupt in a month, that bankruptcy court trustee can go back and take that money that was given to us as collateral for our bond. There's that 90-day period. So we do take cash, but only on a case-by-case basis. And really for foreign companies, as opposed to U.S. companies, because foreign companies aren't subject to the same bankruptcy laws that we have here in the United States. For letters of credit, we do look at bank ratings. So we like to see the information from the importer or from the customs broker telling us who the bank is, and get a draft of the letter of credit to make sure the language fits our requirements. Again, collateral may be required every year depending on the risk and the stacking liability. And we generally hold the collateral until after liquidation, the reliquidation period, because we have been stuck before where we've returned collateral as soon as entries liquidate, but then customs came back and reliquidated with increases. So we typically wait that reliquidation.
On that bank rating approval, I just wanted to point out there, when the underwriter is taking collateral, now they're no longer really underwriting the financial statement of the importer, they're underwriting the financial condition of the bank, right? So that bank rating is what they use to make sure that the bank is going to be around for a while in order to keep that collateral on file if the underwriter needs it for a while.
Right, and like I had mentioned, the Great Recession, right? I mean, how many banks failed back during that time in the 2008 to 2010 timeframe? So we have to make sure that bank is solvent. And, if there would be an issue, that it would be around if we would have to draw on a letter of credit.
Okay, so let's move on to tip number 4, leveraging the importer's history and profile and your relationship with the client to help advocate. So in this section, I'm just going to ask Colleen and Patrice and Maya what their tips are. I mean, the customs broker, we believe, is the most important source of information in a risk assessment. So Maya, what are a couple of examples?
Thank you. Yeah, I would say your relationship with the client. Have they been your customer for 10, 15, 20 years and you know them? You've been out to see their operations, you trust them, you know they're doing a good job. Something like that is really important to pass on to us. Do you trust them enough to offer them a significant amount of credit? That's another thing that would be good to know, because sureties, if they don't have enough information, they'll tend to err on the more conservative side. So anything you can tell us like that to help would be really beneficial.
Great. Thanks, Maya. Patrice, how about you? Do you have any ideas?
Yeah, so another thing is, if your brokerage specializes in any specific commodities, some brokers tend to do anything, and then some people tend to specialize in one specific thing and become an expert at it. So maybe a broker that specializes with importers that import fruit or frozen fish. You have a deeper understanding of maybe those classification codes and also the requirements that not only are just for customs, but other PGA like FDA. So that gives the underwriter a little bit more help to be able to say, okay, well, this broker knows what they're doing. So that's important to communicate to our customer service reps. The same would also be for a drawback specialist. If the drawback is being filed by a broker who's been filing drawback for years and specializes in that, it gives the underwriter a little bit more comfort in knowing that they have that expertise and professionalism as a drawback broker.
Okay, Colleen, how about you?
Sure. So we've always said in the past that, CT-PAT really doesn't make a difference when you're looking at underwriting a bond, because it's really about a supply chain and not their financial wherewithal. Well, that's not necessarily true, because customs does require that they have no open debt in order to qualify for CT-PAT. So it is important to know, right? And plus it's important to know that they're CT-PAT and have that secure supply chain, right? The other factor is if it's a FDA importer, so the FSVP, the Foreign Supplier Verification Program, where most U.S. importers develop this verification program to assure that their foreign suppliers are producing food in compliance with the processes and procedures that US FDA requires, right? So that is a mitigating factor when we have a bond for an FDA restricted merchandise. Well, is this importer on the FSVP list, which you can Google it and find it. So that's another factor too. So brokers that know this, that know their accounts, and oh, by the way, there is a statutory requirement in TIFTIA that importers need to vet their importers and know their importers. So you would know this, right? So that's important. Tidbits of information that we need in order to get it to the underwriters to help get these bonds approved. We're in the business to write bonds, bottom line, right? So we want to write bonds. We don't want to reject them. So the more information to mitigate risk, the better. The other factor could be association memberships. Is the importer in a member of a trade-related membership, the American Association of Exporters and Importers? There's footwear associations, NAM, National Association of Manufacturers. An NCBFAA member. Is our broker account a member of NCBFAA or any of the affiliated local brokers associations? That's a factor too. We know that it's a professional association. You get information from those associations and your CCS points and everything else. So that those are other factors that we would need to help get bonds approved.
All right, thank you. Let's move on to our last tip. Utilizing Roanoke's library of bond sufficiency and renewal tools and guides. So I wanted to talk a little bit about the sufficiency information that we have available to you. We do have on RoanokeTrade.com all sorts of information about bond sufficiency, including a calculator where you just put in, anybody can just enter in the total duties, taxes, and fees, that an importer expects to pay, and it'll calculate the continuous import bond amount for you, the minimum required by customs. We do have a comment here, always project your future 12 months, especially if it's going to be more than what you paid in the last 12 months. Get the bigger bond now is your best option to avoid insufficiency notices from customs or even further underwriter scrutiny. Regarding the bond sufficiency reports that we provide, so every week on Sunday, we do an analysis of all of our active continuous import bonds, and we trigger a notice to you by email when one of your customers' bonds has hit 90% saturation, which is $450,000 total duties, taxes, and fees paid the last 12 months on a $50,000 import bond. We'll trigger a notice at 80% saturation if we see dumping activity. We do also have in the Fast Bond Control Center for our Fast Bond users, if you are the broker of record on the continuous import bond, you can query that bond up in the Control Center, and under the Action drop-down menu, we have our sufficiency summary report that you can print out. And a note on that report is we made it we stripped our name from it so that if you ever wanted to print it out on your company letterhead and give it to your customer, you can do that. And then also our management reports. We do have a section in Fast Bond. You have to have a management access to Fast Bond, which is normally given to owners or management level employees within your brokerage, where you can run all sorts of reports, including some sufficiency reports based on specific importers. And then I also wanted to point out under the sufficiency is we also have on our website a flyer called the Importer's Roadmap. CBP says my bond amount is too small. It's something that you can access right on our website. It's also something that we can brand with your company's branding on it if you want to give it to your customers. You're welcome to cite it or copy, why reinvent the wheel if you have to explain information to a customer about calculating bonds or the insufficiency notice. Have at it. Use that flyer as much as you need to. Patrice, you want to talk a little bit about the underwriting tools that we have?
Yeah, and so, just another form of what Jennifer just said, we have another importer's roadmap that's for navigating financial requirements and compliance for customs bonds. So that can also be branded. It talks a little bit about, not in too much detail of what we said earlier, specifically what they're looking at, but it does talk about the financial statements and the 12-month review and income statement and balance sheet requirements. So that can also be branded and given to your importer so that it's easier for you to ask for that. Most of the time our customer service reps will put that in an email and you can copy and paste that as well. We do have other white papers on our website. One of the ones that, is most helpful is on anti-dumping and countervailing duties. And, what you don't know can hurt you. So it goes really into some depth about the different types of anti-dumping and countervailing duty issues that we have as well.
Okay, so thank you, Patrice. Now it's time for questions. So we do thank you for joining us. I see we're at the 1 hour mark. So if you don't mind hanging on a couple more minutes, we will go through your questions, but you're welcome to, if you haven't already, submit any questions through the Q&A panel. And also just really quick before we go into the questions, there will be a survey after you exit the webinar this afternoon that we would really appreciate it if you'd take just a couple of minutes to fill it out. So that would be great. I'm going to stop showing my screen so you can see our lovely faces. And we do have some questions here that I'm going to go through. So one of them is, will you be sharing this presentation after? Yes, we will. We will be sharing not only the video, but the slides themselves. Probably within the next couple of days, you'll get an email And for those who weren't on first thing, we are also entering everybody who's attended today's session into a drawing, and we will be picking 4 names in the next couple of days, and we'll let you know who the 4 winners are of a $50 Visa gift card, just for saying thank you for spending your time with us this afternoon. Okay, we've got a question here. Colleen. What, if any, pressure is the surety putting on customs to liquidate ancient entries? For example, entries that are over 10 years old that are under suspension for things like ADD reviews?
Well, I know that when we moved from ACS to ACE, we submitted a very long list of entries that literally go back to the 1950s. Because we've been writing bonds that long, actually since the 30s, where this data is still in our system, and clearly the statute of limitations has gone. You need to liquidate these entries. So they did do a big push at the time when ACS, when ACE came about for entry and entry summary. We do know, we look at it from time to time and send it to customs and say, you know, what's going on. You know, their excuse now is it's a pandemic from home. We don't have those files, right? Because they're so old, they're not in ACE. They have to have the physical file to be able to do it. And that's really a problem with old drawback right now. There are literally thousands of drawback claims that still have not liquidated that really should be liquidated. So we're pushing, but you know, we can only push so far, right?
All right, thank you, Colleen. Patrice, I have a question for you that we received. What could cause an underwriting hold on a new CTB when the bond amount is not a concern based on projected duties, taxes, and fees?
Yeah, so that would be, you know, some sort of history that we already have with an importer. It could be that we've written a bond for them before, maybe not through your brokerage, but from a different broker and under our surety company, and either we've paid claims, so there's a hold on the importer. They might have had some underwriting concerns previously, like anti-dumping, and we requested underwriting information like financials, and they didn't provide it. So that causes our surety company to put a hold on that specific importer. So if that comes up and you know you think it's just a $50,000 bond, I would recommend obviously contacting your customer service rep and finding out what the reason is for the hold. Sometimes if it's a paid claim that might be small, the importer has told us before that you know they didn't know it, they didn't receive it from customs at the time. They could pay back the surety company, and that can also sort of help release that hold on the importer.
Okay, Colleen, I'm going to ask you a question we received back to one of your previous slides. Could you repeat the different associations you mentioned under the, you know, why the broker is such a valuable part of the underwriting assessment?
Sure. There, well, the NCBFAA, of course, and you all get 1 point if you're a CCS member or CCS certified. You have the various brokers associations, right, that are affiliated with the main NCBFAA. If your importer clients are members of a trade-related association, so you have AAEI, American Association of Exporters and Importers, the Retail Industry Leaders Association is RILA, the American Apparel and Footwear Association, AAFA, oh my goodness. There's many of them. National Association of Manufacturers. I could go on with a bunch of acronyms if I could remember them all. So we can probably put a list together and post it somewhere on our website too.
I did get a question that I'll take this one. Do we send saturation notices to our to the importer? And we send the saturation notices when we get them from customs. So, you know, we generate our potential sufficiency notices. And if you're not getting those, either A, you don't have any bonds that have hit the 90% saturation, Or it's possible that you're not getting them directly from Roanoke, from our automated program, but our bond rep may be sending it to you. We don't send them to the importer, we send them to our customer because we have your email address. And if you need to, you're always welcome to contact your bond rep to say, hey, send these notices to these people within my organization, and we'll set up your account so that they automatically go. We also get the sufficiency notice or the saturation notice from Customs. They send those to the surety, to us by email, and then they send them to the importer. And that's it. So we have an automated program in place, again, that looks to our configuration for your account that says, oh, Maya is set up as the contact for this account, or whoever the customer is, and we automatically will send the notice to you.
Yeah, and to add to that, sorry, Jennifer, that we send to whoever we bill. So if a broker has, if an importer uses, several different brokers, it's the broker that we bill for the bond. Or the company that we bill for the bond.
Hey, Maya, do you mind answering this question? There's some questions about when collateral is posted and that the bank needs to be approved. Colleen mentioned it a little bit, but if you don't mind just addressing that a little bit, how are they deciding who's approved and who's not?
Well, the underwriters have a list that changes, which is why we can't send the list out and say these are the approved banks, because it's fluid and it always changes, just like our own personal credit ratings change all the time, right? I mean, somebody looks at your credit and there goes your rate. So if you give us the name and the location of the bank, I go to ABC Bank in Chinook, Washington. So then they look it up on the list and they see, oh yeah, that one's fine. So it's kind of a hit or miss type thing. We can't just give you a blanket, these are the banks type thing, but that's how it works. And we don't even have the list. We have to go to the underwriter and they'll say, yeah, that one's fine, or it's not fine.
All right. That's it from the questions that I see coming in. So we only went 6 minutes over today. So thank you everyone for hanging in there with us. We really appreciate it. Like I said, we'll send the video and the slides to you within the next couple of days. And we really appreciate you attending today. And we wish you all as normal of a holiday season as you can have this year. So thank you very much.
Bye. Happy holidays.